You know what's fascinating? While everyone's been watching gold climb past $4,000 in 2025, there's a specific group of investors who are kicking themselves right now. Not because they missed the rally, but because they hesitated at $3,000. They waited for confirmation. They wanted to see more data. And in that hesitation, they watched what could have been a 33% gain slip through their fingers in less than a year. Let me tell you why that $3,000 level wasn't just another price point. It was a psychological Rubicon, a moment when the smart money recognized something the mainstream hadn't caught on to yet. And if you're sitting here thinking you missed it, I'm going to show you why understanding what happened at $3,000 is more valuable than catching the move itself. Because here's the thing. Gold didn't just break $3,000 and keep climbing on accident. There was a specific sequence of events, a perfect storm of factors that converged at that exact moment. And those same forces? They're still in play. They're actually accelerating. Which means if you understand the mechanics of what drove gold through $3,000, you can position yourself for what's coming next. Let me take you back to early 2025. Gold was trading around $2,150. The financial media was doing what they always do, calling for a pullback. Overbought, they said, due for a correction. Meanwhile, something extraordinary was happening behind the scenes that most retail investors completely missed. Central banks were buying gold at a pace we hadn't seen since 1967, not the pace we saw in 2022 or 2023, which were already record years. I'm talking about a complete paradigm shift in how sovereign nations view gold as a monetary asset. The People's Bank of China alone added 225 tons in the first quarter of 2025, but here's what made it different. They weren't hiding it anymore. They were announcing it, proudly. Think about that for a second. For decades, central banks accumulated gold quietly. They didn't want to spook the markets or signal lack of confidence in the dollar system. But in 2025, that changed. China, Russia, India, Turkey, Poland. They started treating gold purchases like a badge of honor, like a declaration of monetary independence. I remember watching a press conference in March 2025 where a Chinese central bank official was asked about their gold purchases. His response: "We are simply being prudent stewards of our nation's wealth in an era of unprecedented monetary uncertainty." No hedging, no diplomatic language, just a straightforward acknowledgement that they were moving away from dollar dependence. That's when I knew $3,000 wasn't a ceiling. It was a floor. But central bank buying was just one piece of the puzzle. Let's talk about what was happening in the physical market, because this is where things get really interesting. The premium on physical gold, over paper gold, what we call the basis, started widening in a way that hadn't happened since the 2008 financial crisis. In London, the heart of the global gold market, dealers were reporting something unusual. Wealthy individuals and family offices weren't just buying gold. They were demanding immediate physical delivery, and they were willing to pay premiums of 3 to 4% over spot price to get it. Now, in normal markets, that premium is maybe 0.51%. When it hits 3 to 4%, that's telling you something about supply constraints and urgency. I spoke with a dealer in Zurich who told me about a client, a tech billionaire from Silicon Valley, who walked in wanting to buy $50 million in gold bars. Not coins, not ETF shares, physical bars. When asked why the urgency, his response was chilling. "I don't trust the system anymore. I want to hold it myself." That sentiment was spreading, and it was creating a supply crunch that the paper markets couldn't ignore. Now let's connect this to something most people don't understand about how gold is priced. The vast majority of gold trading happens on paper, futures contracts on the COMEX, unallocated accounts at bullion banks, ETF shares. For every ounce of physical gold that exists, there are probably 100 ounces of paper claims on that gold. It's a fractional reserve system, just like banking. This works fine as long as everyone's content to trade paper. But when people start demanding physical delivery, the whole structure gets stressed. And in early 2025, that stress was building. The COMEX warehouse stocks, which had been around 25 million ounces, started declining. Not dramatically at first, just a steady drain. 100,000 ounces here, 200,000 ounces there. But it was persistent, and the people watching those numbers, the professional traders, they understood what it meant. It meant the paper market was losing its grip on price discovery. It meant physical demand was overwhelming the ability of the system to deliver. And it meant that when gold broke through $3,000, there would be no natural resistance level above it. Let me paint you a picture of what was happening in the derivatives market. The big bullion banks, the ones who make markets in gold, they typically run short positions. They sell futures contracts to hedge their physical inventory and to profit from contango in the market. It's a standard practice that's worked for decades. But in February 2025, something changed. The cost of maintaining those short positions started skyrocketing. Why? Because the contango collapsed. The futures curve went from its normal upward slope to nearly flat. In some cases, it even inverted, with near-term contracts trading at a premium to longer-dated ones. This is called backwardation, and it's extremely rare in gold. It signals immediate physical demand overwhelming future supply expectations. And for the banks holding short positions, it was a nightmare. They were bleeding money on their hedges while physical premiums were exploding. I know a trader who worked at one of these banks. He told me they had an emergency meeting in late February where senior management made a decision. They were going to start covering their shorts. Not all at once, because that would cause a panic, but systematically, over the coming weeks. That decision, multiplied across several major banks, created a buying wave that pushed gold from $2,150 to $3,000 in less than 3 weeks. But here's where the story gets even more interesting, because while all this was happening in the gold market, there was a parallel crisis developing in the Treasury market that most people completely missed. In March 2025, the U.S. Treasury held an auction for 10-year notes. Standard procedure. Happens all the time. Except this auction had the worst bid-to-cover ratio in over a decade. Foreign buyers, particularly Asian central banks, barely showed up. The primary dealers, the banks required to bid, had to absorb a massive amount of supply. Why does this matter for gold? Because it signaled that the world's appetite for U.S. debt was waning. And if foreign central banks aren't buying treasuries, what are they buying instead? You guessed it. Gold. This wasn't just about China and Russia, the usual suspects. This was Japan, South Korea, even some European central banks quietly diversifying away from dollar assets. The petrodollar system, which had been the foundation of dollar dominance for 50 years, was fracturing. Saudi Arabia had let their petrodollar agreement with the U.S. expire in 2024. They were now accepting yuan for oil sales to China. The UAE was doing the same. Brazil and Argentina were settling trade in their own currencies. The BRICS nations were actively working on a gold-backed trade settlement system. Every one of these developments was a small crack in the dollar's foundation, and gold was the beneficiary. Now I want to talk about something that doesn't get enough attention. The role of inflation expectations versus actual inflation. Because this is where a lot of people get confused about gold's price action. In early 2025, official inflation numbers were coming down. The CPI was around 3.5%, down from the 9% peak in 2022. The Fed was talking about rate cuts. On the surface, this should have been bearish for gold, right? Lower inflation, lower rates, less need for an inflation hedge. Except that's not how it played out. Because sophisticated investors weren't looking at the CPI, they were looking at M2 money supply, which had expanded by 40% since 2020. They were looking at government debt, which had crossed $35 trillion and was growing by $1 trillion every 100 days. They were looking at unfunded liabilities in Social Security and Medicare that totaled over $200 trillion. They understood that the inflation we'd seen was just the first wave, that the monetary expansion of the COVID era was still working its way through the system, and that eventually, all that excess money would show up in prices again. Gold wasn't rallying on current inflation. It was rallying on future inflation expectations, on the understanding that the only way out of this debt trap was to inflate it away. And that meant gold, as the ultimate store of value, was going to preserve purchasing power while fiat currencies eroded. Let me share a conversation I had with a portfolio manager who runs a $2 billion fund. This was in April 2025, right after gold had broken $3,000. I asked him why he was increasing his gold allocation when inflation was supposedly under control. His answer, "I'm not worried about the inflation we can see. I'm worried about the inflation we can't see yet. The government's fiscal trajectory is unsustainable. They're running trillion-dollar deficits with unemployment at 4%. What happens when we hit a recession? When unemployment spikes and tax revenues collapse? They'll have no choice but to print. And when they do, gold is going to be the only asset that maintains real value. That's the mindset that was driving institutional buying at $3,000. Not fear of immediate crisis, but recognition of inevitable outcomes based on current policy trajectories. Now, let's talk about something that's relevant if you're thinking about your own financial security. Because all of this macro analysis is interesting, but what does it mean for someone trying to protect their retirement savings or build wealth? Here's the reality. Most people have their retirement savings in traditional accounts. 401ks, IRAs, brokerage accounts, and most of that money is in stocks and bonds, which means they're completely exposed to the dollar system. If the dollar loses purchasing power, their savings lose purchasing power. There's no escape hatch. But there's a structure that not enough people know about. It's called a gold IRA, and it allows you to hold physical gold inside a tax-advantaged retirement account. Same tax benefits as a traditional IRA, but instead of holding paper assets, you're holding actual gold bars or coins in a secure vault. I put together a free guide that explains exactly how this works. How to roll over existing retirement accounts without tax penalties. How the storage and custody works. What the costs are. It's in the description below. If you've got $100,000 or more in retirement savings, and you're concerned about dollar devaluation, it's worth looking into. Not as your entire portfolio, but as a strategic allocation to preserve purchasing power. All right, back to the story. Because what happened after gold broke $3,000 is just as important as what led up to it. Once gold cleared $3,000 in late March 2025, something psychological shifted in the market. Suddenly, financial advisors who had been skeptical were recommending 5 to 10% allocations. Pension funds that had zero gold exposure were adding 2 to 3%. Even the talking heads on CNBC, who had been calling gold a barbarous relic for years, were suddenly bullish. This is what happens at inflection points. The narrative flips. What was considered fringe becomes mainstream. And that narrative shift brings in a new wave of buyers who weren't paying attention before. But here's what most people missed. The really smart money, the family offices and sovereign wealth funds, they weren't buying at $3,000. They had already bought at $2,400, $2,600, $2,800. They understood the fundamentals before the price confirmed them. By the time gold hit $3,000, they were sitting on massive unrealized gains. This is the difference between reactive investing and proactive investing. Reactive investors wait for confirmation. They want to see the breakout, the new high, the mainstream validation. Proactive investors study the fundamentals, identify the catalysts, and position before the crowd arrives. And the fundamentals in early 2025 were screaming. Record central bank buying, physical supply constraints, weakening dollar demand, unsustainable fiscal deficits, geopolitical fragmentation. Every single factor that drives gold was aligned. Let me tell you about the technical setup, because this is where art meets science in trading. Gold had been consolidating between $2,600 and $2,900 for months. It was building what technicians call a bull flag pattern. This is a continuation pattern that typically resolves to the upside with a measured move equal to the prior rally. The prior rally had taken gold from $1,800 to $2,600, a gain of $800. So when gold broke out of the flag pattern at $2,900, the measured move target was $3,700. That's not mysticism. That's pattern recognition based on decades of market behavior. And sure enough, once gold cleared $3,000, it didn't stop. It accelerated. By June 2025, it was at $3,400. By August, $3,800. And in October, it briefly touched $4,000 before pulling back slightly. But here's what I want you to understand. That move from $3,000 to $4,000 wasn't random. It wasn't speculation or mania. It was the market repricing gold based on a new reality. A reality where the dollar's role as the world's reserve currency was being questioned. where central banks were actively diversifying away from dollar assets, where physical demand was overwhelming paper supply. And that reality hasn't changed. If anything, it's intensified. Let's talk about what's happening right now, in December 2025. Gold is trading around $3,900. It's pulled back from the October highs, which is healthy. Markets don't go straight up, but the underlying fundamentals are stronger than ever. China just announced another 50 tons of gold purchases in November. Russia's central bank is buying every ounce of domestic production. India's import demand is at record levels despite high prices. The physical market is tight. Meanwhile, the U.S. government just passed another spending bill that adds $2 trillion to the deficit over the next decade. The Fed is stuck between a rock and a hard place. If they raise rates to fight inflation, they crash the economy and the treasury market. If they cut rates or hold steady, they risk reigniting inflation. Either way, gold wins. Higher rates make dollar assets more attractive in the short term, but they also increase the government's debt service costs, which accelerates the fiscal crisis. Lower rates devalue the dollar and boost gold directly. This is what's called a no-win scenario for policymakers, and it's why gold has become the ultimate asymmetric bet. The downside is limited because physical demand provides a floor. The upside is unlimited because the fiscal and monetary problems are unsolvable within the current framework. Now, I want to address something that skeptics always bring up. Gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And they're right. Gold is not an income-producing asset. It's a wealth preservation asset. It's insurance against monetary debasement. But here's the question you have to ask yourself. What good is a 5% dividend if the currency it's paid in loses 10% of its purchasing power? You're getting poorer in real terms even though your nominal wealth is growing. This is the trap that most retirees fall into. They focus on income generation without considering purchasing power preservation. They hold bonds that pay 4 or 5% while inflation runs at 6 or 7%. They're slowly bleeding wealth without realizing it. Gold doesn't have this problem. It doesn't pay you anything, but it maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services as an ounce of gold did 100 years ago. Can you say the same about the dollar? About any fiat currency? Let me give you a concrete example. In 1925, an ounce of gold cost $20.67. A quality men's suit cost about $20. So 1 ounce of gold bought you a nice suit. Today, an ounce of gold is worth $3,900. A quality men's suit costs about 800 yuan or $200. So 1 ounce of gold still buys you 3 to 4 nice suits. The purchasing power has been maintained. But if you had held $20.67 in cash from 1925 to today, it would still be $20.67. Except now, it buys you basically nothing. That's the difference between real money and fiat currency, and this is why central banks hold gold. Not because they're stupid or old-fashioned, but because they understand monetary history. They know that every fiat currency eventually fails. The dollar, the euro, the yen, they're all experiments in progress. Gold is the constant. Let's talk about what could derail this thesis. Because it's important to consider the bear case, the scenarios where gold doesn't continue higher. Scenario 1. The U.S. government gets serious about fiscal discipline. They cut spending, raise taxes, and start paying down the debt. This would strengthen the dollar and reduce the need for gold as a hedge. But let's be honest. What are the odds of this happening? We're in an election cycle where both parties are promising more spending, not less. The political will for austerity doesn't exist. Scenario 2. The Fed successfully engineers a soft landing. They bring inflation down to 2% without causing a recession, and they maintain that stability for years. This would reduce uncertainty and make dollar assets more attractive. But again, look at the track record. The Fed has never successfully navigated a soft landing after a major inflation spike. They either overshoot and cause a recession, or they undershoot and let inflation run hot. Scenario 3. A major technological breakthrough dramatically increases gold supply. Maybe asteroid mining becomes viable, or we discover a massive new deposit. This would increase supply and potentially lower prices, But even if this happens, it's a decade away at minimum. And in the meantime, demand is growing faster than supply. None of these scenarios seem likely in the near term, which means the path of least resistance for gold is still higher. Now let me tell you about something that's happening in the derivatives market that most people aren't aware of. The options market for gold has exploded in volume over the past year, and the positioning is heavily skewed toward calls, not puts. This tells you that professional traders are positioning for upside, not downside. But here's the interesting part. The strike prices on these calls are way out of the money. We're seeing significant open interest at $4,500, $5,000, even $6,000 strikes. These aren't lottery tickets. These are sophisticated traders hedging their portfolios against extreme dollar devaluation scenarios. Think about what that means. The smart money isn't just expecting gold to go higher. They're preparing for the possibility of a parabolic move, a scenario where gold doesn't just grind higher, but explodes higher in a short period of time. What would cause that? A loss of confidence in the dollar, a treasury market crisis, a major geopolitical event that disrupts the global financial system. Any of these could trigger a rush into gold that overwhelms the paper market's ability to suppress prices. And here's the scary part. The conditions for such an event are more favorable now than at any time since the 1970s. The debt levels are higher. The geopolitical tensions are worse. The trust in institutions is lower. We're one black swan event away from a monetary crisis. I'm not saying this to fearmonger. I'm saying it because it's important to understand the risk-reward profile. If you own gold and none of this happens, you've preserved your wealth. If you don't own gold and any of this happens, you could lose a significant portion of your purchasing power. That's an asymmetric bet worth taking. Let me share one more story that illustrates why the $3,000 level was so significant. I know a guy who runs a small hedge fund, about $50 million in assets. He's been in the market for 30 years, seen multiple cycles. In February 2025, he made a decision to put 20% of his fund into gold. Not gold stocks, not gold ETFs, physical gold, held in a vault in Switzerland. His investors thought he was crazy. Gold doesn't do anything, they said. You're giving up yield. But he stuck to his conviction. And when gold broke $3,000 in March, then $3,500 in June, then $4,000 in October, those same investors were calling him a genius. But here's what he told me. I'm not a genius. I just read the writing on the wall. The monetary system is broken. The debt is unpayable. The only question is how long they can keep the illusion going. And I'd rather be early than late. That's the mindset you need in this environment. Not trying to time the exact bottom or top, but recognizing the macro trend and positioning accordingly. Because here's the truth. The countdown to $3,000 gold wasn't really about $3,000. It was about the recognition that we've entered a new monetary era, an era where fiat currencies are being debased at an accelerating rate, where central banks are losing control of inflation, where the global financial system is fragmenting into competing blocks. Gold at $3,000 was the market's way of saying, we see what's happening, and we're pricing in the consequences. And those consequences are still unfolding. The debt is still growing. The deficits are still massive. The geopolitical tensions are still escalating. Central banks are still buying. Physical demand is still strong. Every single factor that drove gold through $3,000 is still in play, which means if you understand what happened at $3,000, you can position yourself for what's coming at $4,000, $5,000, and beyond. The countdown didn't end at $3,000. It was just the beginning, and the clock is still ticking.